Success in e-commerce is dictated by the movement of physical goods. A platform survives or fails based on its ability to coordinate millions of physical boxes across a complex supply chain. Standard industry logic relies on a single metric to cover these costs: average order value. To make the economics of a delivery truck work, platforms must push consumers to buy expensive items or build larger baskets. Meesho has reached massive scale following a different trajectory. They currently command over 21 crore users and are preparing for an initial public offering later this year. However, their internal data reveals a contradiction of the standard model. Instead of upselling their user base, Meesho is actively pushing its own order values lower. This data tracks the relationship between user acquisition and per-order revenue. Between fiscal year 23 and 25, transacting users grew from 13.6 to nearly 19.9 crore, while the net merchandise value per order dropped from 281 to just 230 rupees. Meesho is intentionally depressing its per-item margins. They are shrinking their basket sizes to achieve an entirely different operational objective. This strategy is a response to their core demographic, the bottom-of-pyramid consumer. These users are typically located in India's Tier 2 cities and rural areas. Reaching these regions requires navigating severe logistical friction, often involving the manual exchange of cash for goods at a rural doorway. This creates a unique structural constraint. More than 75% of transactions in this market segment rely on cash on delivery. Cash-based systems lead to high failure rates. If a customer is unavailable or lacks exact change, the shipment is canceled or returned, leading to high return-to-origin rates. This section of the logistics economics data shows the impact of that friction. The successful-to-placed metric consistently hovers below 70. For the BOP consumer, these lower price points remove purchase friction. It transforms e-commerce from an occasional event into a frequent, almost monthly habit. Sellers are incentivized to support this model, as moving high volumes of low-value goods allows for faster inventory turnover than holding more expensive stock. By intentionally shrinking the average basket size, Meesho has successfully created a mechanism to drive transaction velocity across the entire platform. The shift toward high-frequency items resulted in a massive surge in physical order volume. This section tracks the physical shipments moving through the system. Placed orders grew from 102.4 crore in fiscal year 23 to 183.4 crore in fiscal year 25, representing a 38% compound annual growth rate. Handling nearly 2 billion low-value packages creates a massive financial risk if processed through traditional, expensive, and physical logistics networks. Meesho manages this risk through its zero-commission model. They generate no profit from the actual retail sale of the items. Instead, the revenue model is built entirely on fulfillment. Meesho charges its 58 lakh sellers a delivery fee to handle the shipping. The retail marketplace serves as a generator for physical boxes. The platform's objective is the movement of the goods, not the goods themselves. To process this volume efficiently, Meesho launched Valmo in 2021. Valmo is built as an asset-light logistics network. It seamlessly manages one of the absolute largest delivery volumes in India, while owning no physical trucks and no warehouses. Valmo functions as a software coordination layer, utilizing a network of over 13,500 independent logistics providers and local delivery agents. Each shipment passes through 4 handovers: first mile, middle mile, warehousing, and last mile. At each stage, independent couriers bid against each other for the package. This competition drives the cost of each handover to the lowest possible rate. This bidding system relies on the volume engineered in Act 1. High route density perfectly ensures that even with extremely low margins per box, the aggregate volume remains profitable for couriers. Valmo operates as an arbitrage machine, using software to optimize India's disorganized and fragmented trucking sector. The Valmo network quickly became the primary fulfillment engine for Meesho's internal orders. Tracking Valmo's adoption, in fiscal 23 it handled just 2% of shipped orders, surging to 62% by Q1 of fiscal 26. This transition significantly reduced costs, with revenue per ship delivery dropping from 66.1 to just 52.5 rupees. This cost structure gives Valmo a significant edge over traditional logistics providers like Delhivery, which must maintain expensive physical infrastructure and larger internal workforces. This comparison tracks the cost efficiency of Meesho's network against Delhivery's reported data. The initial 4% cost advantage in fiscal year 23 grew steadily. By the most recent quarter, Meesho had engineered a 29% cost advantage over the legacy infrastructure. A software-based bidding layer, supported by captive e-commerce demand, has created a structural cost advantage over physical logistics networks. This final section, detailing business economics, shows how logistics efficiency translates into margin stability. Logistics costs have remained controlled at approximately 7.8% of revenue. This stability allowed the overall operating margin to improve from negative 31.5% to negative 10.6%. Meesho currently controls 180 crore of India's 700 crore annual e-commerce shipments, accounting for roughly 25% of the market. As the internal volume saturates, the network is designed to expand. The final strategic step is opening this low-cost logistics infrastructure to external third-party clients. Smaller logistics companies relying on Meesho for overflow volume will be forced to consolidate as Valmo internalizes demand and moves into the broader market. Meesho has successfully used low-value e-commerce to build a dominant position in India's 1 lakh crore logistics market.